Today is Friday, April 4th, 2026. The stock market just closed. The bond market is essentially dark. The Federal Reserve's open market desk issued a statement this morning saying it will not conduct operations today due to the Good Friday holiday. And all of the overnight repurchase agreements and securities lending trades executed on Thursday, yesterday, will not mature until Monday. Let that sit for a moment. Every major financial institution in America just locked in their overnight positions until the market reopens. For the next 72 hours, there is no official mechanism for the Federal Reserve to pump liquidity into a system that is right now under more simultaneous pressure than at any point since March 2020. And here is what makes this particular weekend different from every other weekend that has come before it. The data that came in this week did not reassure anyone. The oil shot from the Iran war is not fading. The S&P 500 is down 4.6% for the first quarter, its worst quarterly start since the tariff shock of 2025. Moody's recession probability model just hit 49%. And the next FOMC meeting, the single most important monetary policy decision since the emergency rate cuts of COVID, is exactly 25 days away. It is scheduled for April 28th and 29th. And it will be Jerome Powell's last meeting as Federal Reserve Chair before Kevin Warsh takes over. The Fed is not just watching the market this weekend. They are preparing. And what they are preparing to do, the tools they have available, the protocol they follow when the system cracks on a weekend, is something almost no ordinary investor ever thinks about until the moment it matters most. Stay with me, because what I'm about to walk you through is the most important financial mechanism in the modern American economy. And right now, it is being stress tested in ways that the public has not been told about directly. But the signals are everywhere, if you know exactly where to look. Every time the Federal Reserve has been forced to act in emergency mode, it follows the same four-stage sequence. Not similar, identical. 4 stages that repeat across every financial crisis in American history with a precision that is almost mechanical. Stage 1 is the buildup of pressure. Stage 2 is the moment of recognition, when internal data diverges sharply from the public narrative. Stage 3 is the deployment of the emergency toolkit, the quiet interventions, the weekend phone calls, the liquidity facilities that get announced on a Sunday before Asian markets open Monday morning. Stage 4 is the public acknowledgement, the press conference, the official statement. And by that point, the intervention is already fully underway and the crisis is either contained or it isn't. Right now, we are sitting between Stage 2 and Stage 3. The pressure is visible. The recognition is happening. The toolkit is being reviewed. And the window between this moment and the April 28th FOMC meeting is precisely the most dangerous stretch of time in the American financial calendar for the rest of this year. Let me show you why. Let me show you the proof. Let me start with the history. The first case study is March 2020. On Thursday, March 12th, 2020, the Dow Jones fell nearly 10% in a single session. The bond market, supposedly the world's safest and most liquid market, began to seize. Treasury yields moved in directions that made no economic sense. Mortgage-backed securities stopped trading. The commercial paper market, the mechanism through which corporations fund their day-to-day payrolls, began to freeze. By Friday the 13th, Federal Reserve officials were not sleeping. They were on the phone with Treasury officials, with foreign central bank counterparts, and with the leadership of the major primary dealers who hold the machinery of American financial markets together. On Sunday, March 15th, 2020, the Federal Reserve did something it had not done since 2008. It called an emergency, unscheduled meeting of the FOMC. On a Sunday, before Asian markets opened on Monday morning, the Fed funds rate was cut to zero in a single move. An emergency quantitative easing program was launched. 7 emergency lending facilities were activated under Section 13(3) of the Federal Reserve Act, the clause that allows the central bank to lend to essentially anyone during unusual and exigent circumstances. The critical thing to understand about that Sunday intervention is not the drama of the moment. It is the timeline. The Fed did not announce that intervention on Thursday when the Dow fell 10%. It did not announce it on Friday. It announced it Sunday night, before the opening bell in Tokyo on Monday morning. Because the Fed's emergency protocol is not designed to calm a crisis while it is visible. It is designed to prevent the crisis from compounding overnight across a weekend in a global market that does not pause simply because American regulators do. The weekend is the Fed's most dangerous window. And this weekend, April 3rd through April 6th, 2026, arrives with more systemic risk loaded into it than any weekend since the regional bank crisis of March 2023. Check. Verified. Undeniable. The second case study is Sunday, March 12th, 2023. It was the weekend between the collapse of Silicon Valley Bank on Friday and the opening of financial markets Monday morning. In those 48 hours, the Federal Reserve, the Treasury Department, and the FDIC executed one of the most consequential weekend interventions in American banking history. The Bank Term Funding Program, the emergency lending facility that allowed banks to borrow against their Treasury holdings at full par value rather than depressed market value, was announced on Sunday, March 12th. The decision to make all depositors of Silicon Valley Bank and Signature Bank whole, including those with balances above the FDIC's $250,000 insurance limit, was announced on Sunday, March 12th, Sunday. Not Thursday when the run started. Not Friday when the bank was closed. Sunday, 48 hours after the crisis became public, but 48 hours before it could compound globally. The Fed does not announce emergency measures during the market panic. It announces them into the silence of the weekend, precisely because the weekend is when the intervention has maximum impact and minimum market friction. Now ask yourself this. What happens if the intervention is needed but doesn't happen before Monday morning? What happens if the pressure accumulates faster than the weekend protocol can respond? What happened in September 2008 when the failure of Lehman Brothers was allowed to go forward without a weekend rescue and the global financial system experienced its worst single week since the Great Depression? The lesson of September 2008 is burned into the institutional memory of every Federal Reserve official who was present. The lesson is simple. The weekend intervention either happens before Monday, or it doesn't happen cleanly at all. Script. The emergency protocol. April 2026, once markets open, the cascade becomes almost impossible to stop. Confidence is not something you can restore in real time when the opening bell has rung and panic is already being transmitted in microseconds through algorithmic trading systems across every time zone on Earth. This is why what happens between now and Monday morning matters more than almost anything that will be publicly announced between now and the April 28th FOMC meeting. The third case study is the most recent and the most directly relevant to the situation we are in today. January 7th, 2026, a Tuesday. Major U.S. bank stocks were hammered in a single session that dragged the Dow Jones Industrial Average away from its anticipated 50,000-point milestone. J.P. Morgan Chase fell 2% in a single session. The sell-off was triggered by what financial journalists described as a perfect storm of analyst downgrades, alarming projections about 2026 operating expenses, and a spike in geopolitical risk. The January 7th sell-off was not a crash, but it was a warning, and the warning was explicit. If upcoming quarterly earnings reports showed credit quality deteriorating faster than anticipated, that sell-off would not be a one-day correction. It would be the beginning of a broader re-rating of the financial sector. That warning was issued in January. It is now April, and the quarterly earnings season that was referenced in that January warning is beginning right now. This week, the bank earnings calls are starting, and what they reveal about loan losses, credit quality, commercial real estate provisions, and non-performing loan ratios will either confirm that the pressure is manageable or confirm that the contagion is accelerating. The Fed knows this. The New York Fed's open market desk knows this. Jerome Powell, who has 38 days left as Federal Reserve Chair, knows this. And every one of them is watching this weekend's positioning data with a level of attention that is not reflected in any public statement or press release. Now let me show you exactly where the pressure is coming from and why this particular weekend is the inflection point. Start with the oil shock. On February 28, 2026, the United States and Israel launched joint military operations against Iran. Within days, the Strait of Hormuz, the narrow waterway through which approximately 20% of the world's entire petroleum supply flows, was effectively closed. West Texas Intermediate crude oil went from $67 per barrel on February 27th to over $111 by March 8th. That is a 66% increase in crude oil prices in less than 2 weeks. Not over a year, in 11 days. Energy price spikes of that magnitude do not stay contained to the gas station. They propagate through the entire economy. Fertilizer prices surged 40% in the weeks following the conflict because ammonia and urea production is directly linked to energy costs. Transportation costs spiked. Manufacturing inputs rose. And the second-order effects, the wage demands, the rent adjustments, the corporate margin compressions, have not yet fully appeared in the data. They are coming. The OECD has already revised its U.S. inflation forecast for 2026 from 2.8% to 4.2%. That is not a rounding error. That is a fundamental repricing of the entire inflationary landscape for the year.